Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoy this episode. Thank you for joining us. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Brian Phillips of the Pearl Fund. Brian, thank you for joining us.
Great to be here.
So what was your background before investing in early stage companies? What did you do before this?
Yeah, so my degree is computer science, so I'm a tech guy. And when I was in college, I got recruited to start a tech company. And a couple of years later, we took it public and then did another one a little bit later after that. So I've been hooked ever since, just working in tech startups. I've been involved in about half a dozen. 2 went public, 2 were acquired by public companies, and 1 I sold through sort of a management buyout. And then I spent a decade or so giving back, working with first-time entrepreneurs in the developing world. So I decided, I like to say I could dig ditches like anybody else in the Peace Corps, but I really wanted to work internationally. I had a lot of experience, and what I was good at is early stage companies. So I thought there must be some nonprofits that focus on entrepreneurship, and there are a couple. Endeavor Global is one that's well known, and then TechnoServe. I was head of worldwide entrepreneurship for them, working with business plan competitions and early stage SME-sized companies around the world, and then was recruited by Goldman Sachs to help with their famous 10,000 Women project. So what they did, which is quite interesting, is they did a study that said the number one way to impact an economy is through SME entrepreneurs. And the number one best way to do that is through women SME entrepreneurs. So to their credit, they put $100 million in their foundation and formed the 10,000 Women Project. And I got involved in that, traveling all over Africa, India, China, Latin America, finding the most promising women SME entrepreneurs and seeing the dramatic impact it had on the economies and where they work. And then I saw the Opportunity Zone law pass the end of 2017, early 2018, which is to fund businesses that are in low-income census tracts in the United States, and just thought that was a perfect fit to open the first fund and jump into that segment. So we're doing early-stage investments for Opportunity Zone investments only, and I'll explain that in a few minutes what that means.
Well, great. So the Opportunity Zone is an exciting thing. Why is that an exciting thing?
Well, it's probably, some people say, the best tax break that has sort of ever been offered by the U.S. government and the Treasury, IRS, and unprecedented is a word that's often used. So the Opportunity Zone legislation was thrown in at the last minute of the Tax Cut and Jobs Act. And basically the high level is if investors take capital gains and put it into an Opportunity Zone fund, and that fund invests that into Opportunity Zone real estate or businesses and hold it for 10 years, the return that they get is unlimited. It's non-taxable and unlimited. So no matter what the gain is, if you meet those criteria, there will be no tax on that gain. So you have to invest it in a qualified Opportunity Zone fund, which means it's a fund that only invests in Opportunity Zone entities. And you hold it for 10 years, and that's the requirement. After that, if you've done that, then your return is tax-free no matter what the size.
Great. So what's your advice for people investing in startups in the Opportunity Zone sector? What do you advise them to do?
Yeah, so the way the law reads is it has to be through a qualified Opportunity Zone fund. So to do so, you need to find a fund that exists like the Pearl Fund, or you can create your own investment vehicle. It has to be capital gains, and it has to have the 10-year hold to qualify. And so you can put that to work. But right now, there are about 300 Opportunity Zone funds that exist in the country. 99% of those are real estate funds. So you're going to see, if you search on this, lots of real estate funds. But there are a couple of us, like the Pearl Fund. There are a couple of Pearl funds now. There are a couple others that are coming, other funds that are out there that are focusing on the business, because the law says you can invest in real estate or in businesses. Either one is fine. It's just the business has got a bit of a later start due to some clarity needed on the regulations from Treasury, which have now come out and made it much better and easier for Opportunity Zone business investing now that we have those new regulations.
So on the other side of that table, what's your advice for people running startups in those sectors? What should they consider before they go down that path?
Well, that's a great question because a lot of people ask us that. Should I do that or should I not? There's quite a few requirements. They're not onerous that are in there if you're willing to follow those. And if you are, you have to be a qualified opportunity zone business and meet the specifications. But what that means is that if you are looking for investors and you can tell your investors that you're a qualified opportunity zone business, what that means is that if they're trying to decide between multiple businesses and if they invest in yours, it's going to be a tax-free return versus the others. That's a pretty big incentive if you're raising capital. It also means that if they're going to get a tax-free return, they may consider investing more into your fund or into your company because the return that's certainly there. And then lastly, it has real benefits that you are operating your business in these opportunity zone, which are low income census tracts. And there is much more of a social impact and benefit that you're having because you're creating jobs, you're growing companies, employees are spending revenues in these low income census tracts. And as a result, that has a large social benefit. So that does two things. One is it means your company that you're building and growing is doing good, whatever your product is that you're selling and offering. But also there may be a whole group of impact investors who are now interested in investing in this sort of company that has this type of return. That's not just a good financial return, but also does good for the environment, does good for the economy, and does good for our country. So if you are a company and you're thinking about it, you should look into what those are. And I'm happy to explain what that means to be involved in that. But you have to be qualified to be able to take capital from a qualified opportunity zone fund.
So let's talk about the state of investing in opportunity zones. Where are we in the industry stage of it, and what changes do you see coming up?
Well, it's as I said, it's very heavy real estate. Estimates are there's around $4 to $5 billion that have been invested in the last really 12 months into opportunity zones. Overwhelming 99% or more of that is in real estate. It's just was easier for big real estate firms to quickly move into opportunity zones and take advantage of the program. The venture investing or business investing is brand new. We were the first. The Pearl Fund is the first venture fund. We have 2 new Pearl funds open. We have a number of other people we're tracking and helping open funds around the country that are investing in businesses. And they got about an 12 to 18 month later start. So we're just starting to see that take off. And so as a result, it's way behind. Numbers aren't really even being measured or tracked on that. Investments are just beginning to be made in 2020 for most of these funds, and they're small funds. What we've seen is with opportunity zone real estate is a lot of the really big real estate funds have moved into this. It's not that different or that difficult than what they've been doing with other funds, empowerment funds and enterprise zones funding and those sorts of things. So they were right on it, and big firms have moved into it. With venture investing and business investing, you're not seeing the really large venture capital funds moving into this space because oftentimes these are small companies. It's almost like seed stage, angel stage. And a lot of the big venture funds, if anything, are moving up the food chain and investing much larger amounts of money and raising bigger and bigger funds. So it's going to be much more of a grassroots angel investors, seed investors, smaller funds putting together these opportunity zone venture funds that these people feel like they are really compelled to have an impact in wherever they live. So a lot of them are very geographically focused. A fund, we put one together in the New York, New Jersey, northern Pennsylvania area for the Pearl Fund. Another one is opening in the Houston only, and another one in Colorado only. And we're starting to see this trend that it's serial angel investors, seed investors getting together, putting together a fund and investing in the opportunity zones near where they live.
Well, that's great. So let's talk about the investment thesis for this sector. What type of startups do you think are going to fit well in this new model?
Well, the opportunity zone law is written in such a way that it's most advantageous that the company was started after the law was passed. You can do it if you existed beforehand, but there are some rules and some hoops you have to jump through. So the law was passed December 31st, 2017. So it's best and easiest if the company was formed after that date. So let's say January 1st, 2018. So that's where one big thing is. If it existed beforehand, you can still qualify, but you have to show that you substantially improved the company since the law passed and put in significantly additional capital. So that can be done, and we're having some companies that are doing that. They just made a change to the regulations around Christmas time that made that process easier. So that's one thing. The second thing is that the companies need to be working in an opportunity zone, one or more opportunity zones. You don't have to be in only one. And they can receive revenue from anywhere in the world, but it's important that 50% or more of the employees and all subcontractors are working in one or more opportunity zones. So if you've got very spread out workforce spread all over the country, you have a lot of people, contractors working at home, those sorts of things may mean that you're not really earning the income and working in an opportunity zone, and so you won't qualify. So that's another thing. Third is it requires that 70% of your assets be located in one or more opportunity zones. So if you're an asset heavy company, those assets are always spread around the country in some particular way, then those are difficult to meet because they want those assets to be in these opportunity zones and the employees to be in the opportunity zones so that that capital is working and improving these areas of our country. So those are probably the biggest things that you need to look out for. But the industry and the sector that you're working in, anything is game except for a few what they called sin businesses. Golf courses, liquor stores, some of these sorts of things are prohibited. But almost everything else really is workable. And particularly tech companies, they're very asset light. And it's really, I think, a great fit. That's what we invest in at the Pearl Fund. So those are really, really good fits. But we have seen everything, lots of clean energy. We've seen lots of stuff. But if you have a heavy services business with lots of people traveling out, those ones can sometimes be a little more difficult to fit.
Right. So what are the challenges for startups that pursue an opportunity zone? Where do you see them spending most of their time working on to meet the regs?
Yeah, so it's you need to move and base the company, and the management team should be in an opportunity zone. So let me just say what is an opportunity zone so that you know what that is, your listeners. So an opportunity zone is a census tract that has shown during the last census, which was 2010, to have at least a 20% poverty rate. So there are many of these in our country, and each governor of every state was allowed to elect, I think, 25% of the eligible tracts. Those were nominated, approved by Treasury, and they are mandated as opportunity zones. So you can look at a map right now. You can search. You can do a web search for opportunity zones map. There are quite a few places that have it that will pop up, and you can enter in an address, or you can just scroll in on a state, on a county, and look and see where your closest opportunity zones are. There are more than 8,700 of them in the country. In every single state, there's lots of them. And some of them are great places to work, and some of them are very, as you can imagine, very, very remote. But we've seen things, everything from Brooklyn to inner cities to things that you just got to look on a map and see where they are and decide, is this a place that I want to locate? The other thing is there are quite a few co-working spaces that exist in the country and networks, and a number of them, a subset of all of those are in opportunity zones. So if you wanted to search on that, you could find and put employees or yourselves in a couple of these opportunity zones around the country that are in co-working spaces, and you qualify.
Well, you see quite a few businesses taking advantage of the opportunity zone. Are there any particular sectors or applications aside from co-working that you think are good immediate opportunities to pursue?
Well, I think there's, like I said, it's up to the founders, and are they willing to meet those requirements, and do they have a product or a service that they're selling that's going to fit in? And you have to look at it in a long term. One of the nice things that I didn't mention about this capital is it's long-term patient capital. Ideally, the company lasts 10 years and then there's an exit, because then their return is tax-free. If it turns out that you get acquired before then they get a nice return, but they pay normal long-term capital gains on that. So the nice thing is how do you go out to investors and say, look, we've got a company that's worth X, and we think in 10 years, we're going to be worth 10X, 20X, 50X, and we want to partner with you and your capital, and we're going to make that more valuable. And many of these investors are not necessarily interested in distributions during that period of time because those are taxable. So they prefer that the capital, working capital, the profits, these things be plowed back into the business so their equity is more valuable. So at the end of a 10-year period, when they sell it, it's going to be tax-free with even more value. So that's actually a nice fit for companies, but they've got to put together a plan that says, We are an opportunity zone business. We're going to stay an opportunity zone business. We understand what that means. We're willing to comply with that. And in 10 years, we plan to get out of the company and all of us to have an exit, because the way that they're going to make their money is to sell that equity so that they can get that tax-free return at the end.
Great. Well, in the last few minutes that we have here, what else should we cover that we haven't?
Well, I think that back to the investor side, I just kind of want to encourage investors that this is a great asset class to look at, and that you can form your own fund. You can find and search for some of the Pearl funds. You can find other venture funds. They're just starting to come out, and it's quite exciting to see what's going to happen. But the return that you can get with these, provided you put in capital gains, is very, very significant. And we expect a lot of capital to be flowing into these. But like we like to say, just because it's a great tax return that you're going to get as a result of this, you need to vet the deals and make sure they're still good deals that you're betting in. And it's a nice additional incentive to have, but you want to make sure you do your due diligence, or you pick fund managers who know what they're doing and investing in the right kind of deals.
Great. Well, how best for listeners to get back in touch with you?
Well, I think look at our website. It's thepearl.fund. And there's some email and connections there. You can email me, info@thepearl.fund is probably the best way, or look at our Twitter feed, The Pearl Fund, @thepearl.fund, and our LinkedIn profiles, as well as the people working at the fund. You can connect with us.
Great. We'll put those in the show notes. We want to thank you for joining us today and hope to have you back for a follow-up soon.
Great. Thanks, Paul.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.